Can't really say good morning now, can't I? Because it is not morning. We're starting the stream pretty late because we are trading FOMC today. The US dollar has had quite a snapback today, if we can pull up the charts here. Yeah, the dollar is down 0.5% today. It is down 50 points on the DXY. You pull up euro dollar and check this out. Check that out. That is a huge run up there. Check out the Aussie. Another huge run up, but also very, very close to the edge of that distribution there. Hello, Rod. Nice to see you. Ari, nice to see you. Let's see. What else do we got? Now, the pound ain't in that hot of a situation. It's like a coin flip right now, whether or not their central bank, the Bank of England, is going to hike or not. Just everyone's commentary is like 50-50 because of the recent move down in the UK CPI. So, UK CPI comes out around here, and you get this nice reversal off of that. And this is one of the things that's now starting to make me think that little bit of commentary I gave last week is, it has really got some legs, maybe. Specifically, the commentary that there could be so much expected US dollar bullishness, so much US economic growth, and a slowdown in US inflation anticipated, that these little hiccups with, for example, all the stuff going on with the Panama Canal, the Mississippi River, those droughts are making transportation prices more expensive. And now you have the UAW stuff, and also you have more institutions and outlooks coming in and giving more realistic pricing probabilities towards the US government shutting down for a week or two. Sometime in October, right? Like first week or two of October. So any one of those events is not going to totally ruin the US economy and its growth. But what I think a lot of analysts are missing in their analysis, just kind of going hand wavy and saying, you know, we can do the breakdown and we can show like all this stuff for the United States. You know, that's not going to have a super big impact. That's not going to have a super big impact. But when you take in these 4, 5, 6 catalysts that are supposed to be occurring over kind of the next month here, I mean, all those effects are going to compound on top of each other, you know? It's not going to be like one isolated risk that's occurring right then and there and gets absorbed into the economy. It's like you're going to have a couple of rolling events back to back that are actually idiosyncratic to the United States. So, with that going on in the United States, and now this potential for surprises in the economic data for the G7 in China to potentially rebound. For example, a big reason why Aussie dollar rebounded over, I'd say, the last week. I gave that commentary on these factors back here on the 13th. The big reason for this nice positive drift and now this jump up here today is explicitly because of Chinese stimulus. New Zealand dollar is in the same basket. You can see, same. So, if we start to see actual continued disinflation in the CPIs and the core economic data out of the rest of the G7 and in China, and we don't see China slowing down anymore pretty much from here, and we see continued stimulus from the Chinese, a lot of the expectations for recession in Q4 might end up going away for at least the global economy. Who's to say what happens in the US and in certain parts of the world? But I even gave a little spiel on these live streams one and a half years ago, where I said, you know, the post-COVID trading environment, especially post-2021, you have to be knowledgeable of the idiosyncratic risks, the individual risks from one country to another. You really, really, really have to be smart when you're trading throughout effectively the next several years from this point on, until the world has more globalization and more cyclicality brought back into it. Because the world is still recovering from COVID to an extent. Globalization kind of retracted over the last year, especially since Biden's been elected. Like all this stuff going on with BRICS expanding. There's a lot of people talking about trying to just make BRICS a thing. I don't think BRICS is going to be that big of a thing. You know, there's a lot of conflicts of interest within BRICS, in my opinion. And I already posted about all that sort of commentary when BRICS announced their expansion. So yeah, I got this larger view in my head for kind of the month ahead that the United States might be underperforming here. So whatever happens today happens. I have an expectation today that the US dollar will probably get stronger. But it could be in a very volatile way. The other part is the majority of people are already anticipating that the Federal Reserve will put in an extra rate hike, price it in, put it into their dot plots in November for their November meeting. Everyone already anticipates that. The question is that priced into the market or not? It seems like it. It seems like that's the majority view. And if that's already the majority view and it's quote unquote already priced in, or the impact is minimal, then, you know, my original expectation was I would fade any US dollar weakness going into the end of the month. But if this is the scenario where everyone's future expectations are already lined up to a T for a strong US dollar, and now we're starting to see the winds move in slightly the opposite direction, and we're getting this major whipsaw, like it's time to be on the tiptoe side of things until maybe for like next week. Like, don't get me wrong, there's a lot of economic data that we still got to go through. We have flash PMIs coming out this Friday, guys, and that can be a hell of a volatile period. And that could be an especially big risk on day into the end of week. Like, we could have a very, very volatile 72 trading hours here in the FX markets and in equities and in bonds. It could be a very volatile 72 hours here, where you see US dollar strength from the rate hike, and now the market's pricing in the next rate hike for November, only then to look at the flash PMIs come out, and then the flash PMIs say something along the lines of, hey, our economies are recovering from the really crap economic data we had over September. And then you get another slew of CPI reports that come out and say, actually, our inflation's coming down. But then again, poor Canada, right? I don't know if you guys are up to date with what's been happening with the poor Canadians. We traded this yesterday on stream. This little dip here. And I got stopped out on it twice, and then I had to hop out here. And I'm like, dude, this is just all sorts of chop, in my opinion. Like, this is, dude. First off, the Canadians aren't doing so hot. Their inflation is accelerating and at a faster pace. Like, dude, what's it mean when you say fade? A fade simply means you sell as something's going up or you buy as something is going down, right? Because you want to sell high and buy low. Yeah. So I was buying. I was technically fading into this, right? I was buying into these lows. I got the little rebound, and then I'm like, huh, hopefully I can hold this for the rest of the week. But then it just pulled back, and I'm like, Canada is especially supposed to be weak because their CPI is coming out higher. Their inflation is increasing, and the likelihood that they do another rate hike out of the Bank of Canada is also quite low. So here I am looking at this, and I'm like, dude, either you get some bullish reaction out of this pair, you get some dollar strength out of this pair today on the FOMC announcement, and then it continue. And if this pair continues to fade lower, and the Canadian dollar continues to even get stronger because of oil prices, right? Because the Canadian economy is very, very, and its growth is very closely tied to oil. And all across pretty much every single outlook that I read, more and more people are coming to the consensus like, yes, OPEC and Russia are going to keep supply constrained probably going into the end of the year, if not potentially constrain it more. So there's real risk that you see upside to oil. If not, it just holds on to these prices. Watching from India, nice to see you, Rohit. Yeah, nice to see you, James. Nice to see you, Prinsley. Ari, then again, yeah. Nah, man, like, this is the time where you got to be reading as much commentary and research as you can about the things that you're trading to really understand what the hell is going on. Otherwise, you really run the risk of getting blindsided by expectations just flipping on a dime. I mean, just like this. I mean, I pointed out on the 13th of September, hey guys, there's this real risk that all this stuff with the G7 getting some surprise, even little economic surprises that are positive for these G7 countries can lead to outsized moves in their favor because of the strong positioning and expectations for the US dollar that people had, even back here. And, I was on this ride. I rode this whole thing up, and just all the people who rode this up, just as this thing was trickling down, the whole reason why we trickled down all this way is explicitly because we started to get one step of positive data, then another step of positive data, and all these economies kept putting one foot in front of the other, one step at a time, and we just kept getting neat little positive prints of economic data all throughout September. And now the question is, do we continue to see that going throughout October? And not only that, but when you take all of those cumulative risk events that are occurring in the United States into account, right? You take the UAW strike, you take the writers and actors Hollywood strike, you take, the government shutdown risk that's increasing today. Like, I'm getting outlooks today talking about how they're now, like, from B of A. I just went through the B of A research not too long ago, and it's just like, dude, the B of A research is like, dude, we're starting to just actually just straight up pencil in that we are going to see the US government shut down for like 2 weeks, right? In the first 2 weeks of October. So I thought that the US government shutdown was a pretty low risk event, because from the news articles that I'm getting and the journalists that are at Washington D.C. following up with all the people in the House who are trying to maybe buy some extra time, all this stuff, dude, it's still not looking good. It's like a coin flip now. It went from like 80-20 odds earlier this week, later last week, to now getting to be more like people are now putting it at 50-50. Now it's becoming a more significant risk. And if that occurs, your spending in GDP for the G section in your government spending, now that takes a tank in the United States. Oh, you haven't heard about the US government shutdown? No, dude, the government has to fund itself. There are these funding bills that Congress has to pass, and the US House of Representatives is demanding cuts on the spending. And there are disagreements over what should get cut. And right now, everyone's at arms with each other, trying to figure out what should get cut, what shouldn't get cut, how much should get cut. And it doesn't seem like enough. We're going to have enough time here. The risks are really going to heat up next week. And not only will the risks of a US government shutdown really go up next week, but also the actual economic impact of the UAW strikes will also accelerate, because the strikes so far for the UAW have only encompassed like 10 to 30,000 of their 150,000 members. It's been a fraction of the total union. Well, next week, they'll have more people who are members of the union go on into striking. And that will have a bit more of an impact. And then in the following week, they'll put more people on the strike and have a bit more of an impact. So you have UAW, the writers and actors in Hollywood. You have the government shutdown. But there's more, Joe? Yes, there's more. The U.S. is not in a fantastic situation here. You also have this stuff going on with Panama. In fact, Patrick Bet David, the guy who runs the Valuetainment YouTube channel, he went ahead and did a whole video on the Panama Canal and all the potential negative economic ramifications that could have for us, explicitly in the fourth quarter for consumer spending and inflation. You could see consumers having to pay much, much higher prices in the United States for their goods going into Thanksgiving and Christmas this year that people in Europe and Australia and New Zealand and everywhere else won't have to pay. So there'll be this disproportionate impact to the American consumer that you won't see in these other countries. And this stuff going on with Panama, effectively, it's a huge amount of trade that goes through the Panama Canal, goes to the United States, right? It's why the U.S. has a huge interest in the thoroughfare of all the shipping that goes through the Panama Canal, because most of it goes to the United States. Well, Panama's in a drought, and we're talking about a canal here. So when your canal is having a drought, it means you can't put as many ships through it, because in order to put more ships through it, you need enough water. If you don't have enough water to lift up the ships, then you have to deload and make the ships lighter, and so that then they can actually get floated up. If you don't have enough water to float up a super heavy ship because of a drought, then now suddenly you're able to put less stuff onto the cargo ship. And now suddenly the remaining cargo space becomes limited. So the price of the cargo goes way, way, way up because you're only able to put so much now onto the ship. And so it's not just the Panama Canal that's in a drought. It's also the Mississippi River. So all of the United States' grain import and export up and down the Mississippi River is also in a major drought. And the costs for shipping stuff up and down the Mississippi River is also going up. Oh, and don't get me even started about all the stuff that's going on right now with how people are trying to structure the yellow bankruptcy and how trucking prices are also going through the roof. Oh, man. You know, it's just like one thing on top of another. It's just one thing on top of another. You go ahead and you just take any single one of those events, and it's like, oh, yeah, you know, it'll be sort of bad for the economy. You know, I get it. But when you start looking at things holistically and taking the 5, 6, 7, 8, 9, 10 risks that are out there and realizing that they're all going to be happening, rolling in roughly the same amount of time, you're like, oh, wow, I need to add up all of these risks potentially together. And that could lead to negative surprises for the United States' economic data. And so you compare that to all of these somewhat moderately nice economic surprises that we've been getting out of the UK and Australia and China. Well, just wait over the next 2 weeks. Maybe we'll get some nice data out of Europe finally instead of these, you know, sick man of Europe, Germany numbers, right? Hopefully we'll get some better information out of that. I don't know if we'll actually end up seeing that, because from what I just read today, there's all these Apple retail shop workers in France that are now going on strike and unionizing against Apple. So, oh man, yeah, that's not too good. But then, you know, we'll see how long that lasts. Oh man. I don't know. You guys enjoying this commentary so far? Hopefully this is good stuff. So no, I see real risks of the negative US dollar surprises around the bend here that a lot of people might be underestimating, simply because they're looking at one or two of the risks that I've just mentioned, and they're not considering the additive or multiplicative impact that having 3, 4, 5, 6 of these happening over the span of like the next month, 2, you know, span out that time window, but roughly over the next month, you would anticipate more people would be aware of like, oh wow, you know, shit can really hit the fan here coming up. So now with that little bit of commentary out of the way, we can kind of start looking at some trades, use our trading indicator, right, our range probabilities to figure out how we're going to probably be approaching the day here. A1 info for no, dude, this is, I mean, arguably the info I got is a bit better because I'm reading research from heads of quantitative research and heads, you know, senior economists who've been in the business for 20, 30 years. I'm looking at what all these guys are saying, and then I'm being my own analyst, compiling all this information together, right? Putting it together in my own words and my own thoughts and my own analysis, and trying to figure out kind of what's the next logical step. Is there any information missing? Putting it all together, you know? Let's see here. But thanks, James. Appreciate that. How do we expect of AU to move if no rate change? Well, that's already the expectation for the FOMC, right? The FOMC is already expected not to change rates. In fact, it's like 99% priced in when you look at the CME Fed Watch tool. Here, I'll bring up Aussie dollar here. So it's already pretty much priced in, and I mean, let's see here. Should I turn on my drawings? What's going on here? Where are all of my drawings? Oh, do we have another situation where, yeah, it's just not synced globally again? No, that stuff is synced globally. What's going on here? Yeah, it's catching those drawings, but not my latest drawings. That's oh boy, TradingView. I mean, I've loved all the improvements TradingView has been giving me for all these years, and I will continuously support them. It's just sometimes it's like, please give me updates sooner rather than later. No, but the big thing to really look out for is what are the FOMC's future expectations for rate hikes, right? We already have the expectation that they're not going to change much. But that's not what's going to end up making the US dollar stronger or weaker today. What could make the US dollar a lot stronger today is not necessarily if they just give a rate hike expectation that they will hike 25 basis points in November. But what if they also say, oh, well, we could also do 25 in December as well? Like they put in an extra 50 basis points of hikes. Plus, they give very hawkish commentary. Powell gives very hawkish commentary, right? Everyone across the board anticipates a hawkish pause out of the Fed. And the US dollar could get really, really strong off of this, and then it could immediately get faded come Thursday, Friday of this week. And then you just see the dollar have rip, roar, and a tear against it. Like, there is some significant risk still going into the end of the month. Like, this move could come out of nowhere, right? Quote unquote nowhere. But that's simply because most people aren't anticipating and trying to position themselves now for the potential of this surprise, these surprise moves out of the rest of the G7. So, I mean, look, this is such a tricky spot to be in because net, the expectation is that the United States should be the top dog here. The United States and the US dollar should be getting stronger. When you look at all the current data, and even when you look at a set of forecasts and all the official forecasts and a good set of, distributional forecasts out into the future, it all looks quite dollar bullish. But what those distributions and those forecasts don't take into account is the scenario analysis and how those distributions and those forecasts might change when you have a new set of outcomes, which is specifically what if you have surprises? Let's say downside surprises, positive downside surprises in CPI for the rest of the G7, but slightly higher than expected inflation out of the United States. No, it'd just be the reverse of the dollar smile. It would still be dollar smile theory, actually, Ari. Because the whole point, actually, the dollar smile theory is a great way to put this. I didn't even really think about that too much, but no, if you know what the dollar smile theory is, a big part of the dollar smile theory would be you have a smile, and at either ends of the smile, the peaks of the smile, you have the United States is doing really, really well in a world where the United States is the top performer and when the United States is the best of the worst, right? The entire world's in a recession. The entire world is slowing down. Well, people will move into the safest currency to preserve their value. On the other side of the smile, it's everyone is doing really, really well, but because some of the best, fastest growing and innovative companies are in the United States, you can maximize your growth in the United States, so you end up also having a strong US dollar in high growth environments. But in the bottom of the smile, at the very, very, very bottom of the smile, you have this scenario where the United States dollar gets weaker because the United States itself is not performing as well as the rest of the world, even though the rest of the world is doing fairly all right and well, if not growing. And that seems to actually line up with that original expectation that I've been giving, which is the rest of the world can do pretty all right, but there are some specific idiosyncratic risks that the United States has that a lot of these other countries don't, that could cause negative surprises in the United States that don't necessarily affect the rest of the world. So we could be in a scenario where we actually see potentially the bottom part of that dollar smile set up. That's actually a good one to point out. Thanks for reminding me about that, Art. But yeah, dollar smile is a good way to explain that scenario. Oh, I should turn on the music. I keep forgetting halfway through the stream. Turn on the music. Turn on the music. It's just I start getting right on into my speeches, my commentary, and I'm like, yeah, I'm on a roll here. I'll go without the music for a little bit. Yeah, let me know what you guys think so far of the commentary. Yeah, man. So I'm just kind of checking out what's going on in the world here. As far as my expectations for how I would like to trade the FOMC, I would just like to see dollar get strong right off the announcement. Maybe a bit of volatility of like 20, 30 pips in the opposite direction, and then it just gets smacked down. So when I mean smack down, I mean dollar gets stronger. I'm looking at this chart and thinking down, which is dollar strong, right? It'll be interesting to see if I'm just, while I might not be correct on the price forecast for these, I wonder if I'm correct on the timing of this stuff, right? Because this was down up until here where it actually rotated, and now it's down. So yeah, no, this is just, these arrows are just flat out wrong on my expectations for where we would be in price, but I'm kind of curious if this ends up being correct as far as kind of the cyclical aspect of my expectation. But no, I definitely see that still potentially being a risk, at least on the Aussie side of things, considering if China continues holding its ground and not going into a recession with their banking sector and their real estate sector. And I bring up maybe their banking sector might crash because it is heavily, heavily tied to their real estate sector. So we'll see. We'll see. But there's only so much time you can be waiting on China to collapse before the returns have already come and passed you. Nah, I don't got any. Those are Beethoven plan. I believe US may surprise today. I think Powell might do that as well, and my reasoning is they really don't like what Saudi and Russia is doing, and they see that inflation could stay stickier for longer because of that. So they might throw in an extra hike in there just to make sure that inflation does move lower, that people, that it does continue moving lower. They'll say, oh, we're totally willing to reaccelerate if inflation doesn't move down fast enough. Because the ECB said that as well, I think. If I remember, the ECB, Lagarde, said a few times, actually, hey, if we don't get inflation to target within a reasonable time frame, we might reaccelerate. And it seems like that went over people's heads as well. Like, so if oil stays high for long and it keeps inflation sticky and flat, yeah, even though on a rate of change basis, month over month, year over year, quarter over quarter, whatever measure you like to take, just because inflation is going flat or a bit sideways, or maybe has a small decrease, they want inflation at target. And if that requires them to go another 100 basis points in order to kick it down there, they'll do that. They're not gonna have a wait and see and just let the markets adjust to the current state of rates. Like, no, they want inflation at target now. They see it on an absolute level at very high elevated levels, and they want to kick it. They want to kick it down. And whatever it is they got to do to kick it down, whether they need another 25 basis points or another 50 or another 100, they'll go ahead and they'll price that in. So yeah, no, there's a non-zero chance, at least in my novice and analytic position, that yeah, all this stuff going on with Russia and the Saudis might make the Fed on the more hawkish side. That could explicitly make the Fed on the more hawkish side, just so that then inflation doesn't become, quote unquote, sticky. They don't want inflation sticky. They want inflation trending lower. If inflation is not trending lower at a meaningful pace consistently over time, that doesn't make the Fed happy. And, people will say, oh, the series is just volatile. Well, no, it's not just that inflation has some generally speaking, food and energy is a volatile component of CPI. But we can see that the oil production that's coming out of Russia and the Saudis, that's their economic policy. That is the policy of the country. That is not like some volatile, huey thing that you see month over. Like, no, they've established, we are committing to this level of production until we see improvements in oil price. And the whole Western world is kind of in opposition to that. And these central banks will continue to hike in order to bring down the inflation. And whether or not that's the right or the wrong decision, I think it might be, I'm of the, I'd like them to be kind of in the middle ground. I'd like them to be a little more aggressive, but maybe not just be so aggressive that they're doing the kicking, right? They're not trying to kick down inflation, that they do a little bit of extra hiking. They do what they need to tell the market, yes, we are working on this and we will be hawkish and we will continue to hike. And if there's one or two prints, if there's, let's say, 2 prints in a row that are bumps in inflation, we will issue a 25 basis point hike, stuff along that line. And I think it's totally within reason to anticipate that the next CPI print in the United States might be a bit higher. In my opinion, it seems reasonable to anticipate that. Inflation was a tad higher in the last reading, so you get one more reading that's maybe a tad, like another 10 or 20 basis points higher. Because remember, a big reason why the US dollar got strong here at the beginning of the month, this was core CPI. Core CPI came out bigger than expected. So who's to say come this week and then next week, come the next core CPI, that it's also not a bump higher? Like, Fed, like, it might be a policy mistake if they don't hike here. If they don't hike this meeting, it might end up being a policy mistake, because the next opportunity they'll have is November, and they'll have this inflation print and this inflation print, and then November's inflation. They'll have 3 inflation prints that could be increasing. And it's just not the Fed's job to do this front-running stuff, right? It's not the Fed's job to hike in anticipation of higher inflation here and higher inflation here. No, I don't think the BOJ is going to surprise. No, it doesn't seem all that likely that the BOJ is going to surprise. Maybe they'll talk about their future expectations for when they'll hike or when they'll change their near zero interest rate policy or their yield curve control. But right now expectations are that they'll maybe change it in January or April of 2024. So it's a ways away still. So, however, it's still not totally out of the question that the Bank of Japan or Ministry of Finance does some FX intervention once USD yen goes above 50. Like, I still see a lot of forecasts for this 150 here. Yeah, even if you just have like if you have another 50 or so point, if you drift up into and you close above 148 at the end of this month, it's not unlikely that you hit 105 or above next month. And then at that point, like, you could tell maybe by like the second week of October, maybe the BOJ and the MOF will come out and start doing statements saying, oh man, we may have to intervene. It's very urgent. You know, where the yen is very, very weak levels. Yeah, do not fight the Fed. Yeah. Do not try and fight the Fed. But also around here, no, this is the first 2 weeks of October. This is the primary point in time when the risk of a U.S. government shutdown is currently being expected. Well, if the U.S. government does shut down, it means less money is being spent. Funding and spending in the U.S. government, the G in your GDP equation, is much, much lower. I would like... actually, it would be a good thing for me just to check out a historical study, a historical piece of some research on how various assets have performed during U.S. government shutdowns. Like, when the U.S. government does have these funding shutdowns, does the U.S. dollar always get strong? Does it get strong in every case? What is the median return on US dollar strength or weakness when those events occur? Like, those kind of questions are the kind of questions I'm interested in getting answered around these sorts of topics and around these sorts of events. Because that's stuff I can actually work with, right? That's stuff I can actually use to trade. I mean, it's not financial advice, right? Because you still need to figure out where to get in, where to get out, what times, and it's highly dependent. You know, if you're taking trades based off of what the government's doing, you know, don't get me wrong, it works in a lot of cases. That's how a lot of people make their fortunes. They take trades because of some government policy. I mean, that's how I traded COVID really, really well. I could tell you March 20th, 2020, the Federal Reserve sent out an email saying we're going to open swap lines with all the major central banks because US dollar liquidity is zilch. Oh, are we now getting close to the FOMC meeting? Yeah, we're right, Ari. Yeah, you're right. We are very close to the FOMC meeting here. You know, we had the Bank of Canada statement. Let's check out USD CAD. It looks like it didn't really change. It had a bit of a bump, bit of a pullback. Yeah, it didn't change all that much. Let's see. So Powell comes on at 11:30, so this stream's gonna be going for quite a while. Oh, look, my drawings came back. Yeah, I had to hop out of this trade, which sucks. I hopped out of it midway through the stop, and then I got back in up here. And so far, so good. So I think I'm risk managed this trade fairly well. And is my Aussie drawings here? No. There we go. I got my Aussie drawings. So let's see here. I think I got I think I got stopped on this one because this was a very volatile snap. And then I took another shot here. So we'll see how the trades are going. And then I'll turn on Financial Juice in about 5 minutes from here. Bring up the economic calendar. Yeah, look at all these. Yeah, look at that. Interest rate projection, projection. Yeah, so if all these come out higher than the prior number, all these across the board, if all these interest rate projections end up higher, it'll probably make the dollar stronger. It'll probably end up making the dollar a lot stronger. I think that's a half-decent, reasonable expectation to have. Alrighty, we are now less than 10 minutes away from the FOMC meeting that we'll be trading today here. I am currently long the US dollar against the Australian and Euro. Against the Aussie and the Euro. So we'll see. Will I be down another 20 basis points on these two trades, or am I going to make all these paper cuts back? We'll see. It's also very, very nice when you can take 1, 2, 3, 4, 5, 6, 7, 8. You know, when you know your risk of ruin probability is near zero, it's nice. I mean, it helps when you know what you're doing, and at least you're staying knowledgeable on the latest and greatest research from some of the smartest people, and you're proactively going to those institutions to get that research and staying on top of it every day so you're informed. That's just a whole nother breed, right? Staying informed on the latest and greatest research always will give you, especially when you're doing stuff on the discretionary side of things, I think a bit more of an edge. It makes you a bit more informed about what's going on. It may not help you execute the trades absolutely perfectly as always, but you know what? I'd rather have that information than not. I love how I haven't even asked for likes and there's already like 3 likes on the video. Oh, that's nice. Yeah, I've been quite enjoying how there's been a lot more people watching these streams now. Like, oh my god, I'm starting to blow up now. Holy crap. It's nice having viewership. But I gotta thank you guys, Ari, Milos, James, all you guys hanging out in the chat. Let's see here. Santiago, good afternoon, everyone. Yeah, good afternoon, everyone. Let's pull up the DXY. Actually, let's real quick do a rundown. So the UK is doing really well. Europe is nice and hot today. Stellantis is doing pretty well. Chevron, okay. Chevron's doing okay. Oh man, we still have those Chevron LNG worker strikes going on, don't we? I need to get an update on that by the end of this week. I need to figure out what the update is on that strike in Australia is. Because that might make it might make LNG just a bit more expensive in Europe. It doesn't help that they just had another oil field. I think it's called the Troll oil field, I think, or nat gas field. That just went down in Europe. There was an outage, and that made nat gas have a heart attack again. Oh, poor European nat gas, always getting hit. So let's bring up the DXY. Yeah, it looks like, dude, either this has to be the bottom on the day, or I mean, there's a bump here in the distribution that I see around 104.3. This 104.3 spot. Oh man, that it sucked to go down there. I'd get stopped, but you know what? I'd get stopped, you know, before we moved this far, right? Yeah, we'll talk about this later, boy. I'm really honest. Yeah. Yeah, man. Absolutely. Yeah, you could tell me what's happened in that field. You can, if you follow that news, then for sure, tell me what's been going on in that field. All right, we're 5 minutes away from the FOMC meeting. I'm going to turn on Financial Juice here.
And the FOMC rate statement.
Yep, and that was our friends over at Financial Juice.
Looking at more analyst notes, JP Morgan say for investors this will be an important information. However, it is also important to keep an eye on building pressures that have the potential to tip the economy into a recession in 2024. While the Fed may plan for a gentle decline in rates in the years ahead, there is significant risk of an economic stumble that would precipitate much more rapid easing as we descend on the other side of the tightening mountain. While we do not expect any further rate hike at this meeting, they will release a summary of economic projections, giving their updated perspective on the likely path for economic growth, employment, and inflation. Some notes from Wells Fargo. The FOMC has gradually slowed its pace of tightening since late last year, consistent with the policy rate nearing, if not already at, its ultimate destination for this cycle. We look for the FOMC to leave the Fed funds rate unchanged at 5.25 to 5.5% at the conclusion of its upcoming meeting today, September 20th. Economic activity has continued to hold up relatively well considering the 525 basis points of cumulative rate hikes since March of last year. Recent readings of core inflation also suggest that price growth continues to ease on trend. Core CPI rose at a 2.4% three-month annualized rate in August, its slowest pace in more than 2 years. Notably, disinflation is broadening beyond just a handful of categories. While still higher than traditional core, the medium CPI moderated to a 3.6% three-month annualized rate in August. However, we expect the committee to be closely split on whether additional tightening this year will be the most likely outcome. The September meeting will include an update to the summary of economic projections. In the most recent dot plot published in June, projections showed a median Fed funds rate of 5.625% at the end of 2023. Assuming that the FOMC does not hike on September 20th, that would imply one more hike in November or December. We would not be surprised to see the median projection for 2023 slip to 5.375%, as expected progress on inflation has started to turn into realized progress. To that end, we look for participants to lower their year-end projections for core PCE inflation a couple of ticks, which would be the first downward revision to core inflation projections since 2020, and a sign policymakers are feeling more confident about inflation easing.
That all sounds correct to me. And we'll put on the, let's do a 1 minute chart. All right, so we got NQ here, the ES, DXY, and Eurodollar. And then all of our economic data here on the right.
1 minute remaining. I'll lead with the US interest rate decision.
All right. Good luck, you guys. 30 seconds. We're seeing the spreads widen across the board here on all the exchanges.
10 seconds.
Oh!
No change, no change. Rate remains unchanged at 5.5% as expected. Fed
Right
officials'
off
median
the
view of Fed
bat.
funds rate at the end of 2025, 3.9%. Median view of Fed funds rate at the end of 2026, 2.9%.
Wow, Euro is getting hit especially hard. So it looks like the future expectations got more hawkish.
2023 median rate forecast stays at 5.6%, and 2024 rises to 5.1%. 12 officials see one more hike this year, and 7 see on hold. The Fed says inflation remains elevated, and we're highly attentive to risks. Fed policymakers see much higher GDP growth of 2.1% in 2023, a lower unemployment rate, and more progress on core inflation than they saw in June.
Look at
The Fed
that
repeats it will
across the
continue to assess
board.
additional information, and the US banking system is sound and resilient. Fed forecasts show 2023 unemployment at 3.8% versus 4.1% in June, and job gains slowed in recent months but remain strong. The Fed will continue same pace of reducing Treasury and MBS holdings.
Dude, that dollar got
language
strong.
on extent of additional policy firming.
So Fed projections imply one more 25 basis point rate hike this year. Oh, and 50 points of cuts in 24 versus 100 points of cuts. That is what made dollar strong today. It was the 2024 expectations becoming more hawkish by another 50 basis points. If that wasn't there, oh, we got the dot plot. We got the dot plot. Let's see here. Moody's. There we go. Let me go ahead and bring up the research tab. All right, you guys. This is the summary of economic projection. This is what has made the dollar so much stronger today. So what we're looking for is this thing. Alrighty, economic projections. Oh yeah, I can compare it directly with this. So let's see here. Longer run, around 2.5%. A longer run, also 2.5%. But there's a couple people who moved up higher on the longer run. All right, how about 2025? 2025 was kind of hanging around 3.5%. 2025, it moved higher. It moved higher in 2025 as well. More people moving up higher. Yeah, more people are moved up to like the 4%er spot. Yeah, less people expect a less than 3% rate from the FOMC in 2025. This is way more hawkish. And then for 2024, we have 4.25%, right? Oh man, now it's a straight up 5 or 5.25%. This, yeah, this is extremely hawkish. I mean, no, yeah, they definitely are. They've done what they needed to do to make the dollar strong going into the end of the month here, my man. Well, will it stop? It's never gonna stop. This ride, you never get off this ride. Well, all right. I got my dollar strength. I stuck with my expectation, and I just got paid today. Fantastic. Now it's, will this continue? Right? Let's go back to our 3-hour here. Yeah, check out that DXY. I was like, the low's like, again, the thing had to reverse like that in order for this to work out. So the fact that it did, I mean, you can now look at this on a daily. It's, yeah, you're probably going to see 105.8, 106 on the dollar by the end of the month at some point. Potentially. It's more likely, in my opinion, by interpreting this indicator, we'll see 105.8, 106. Because the Fed was a lot more hawkish than people anticipated, than I anticipated. This change in future expectations for the Fed is a sizable move forward in you keep screwing around and we will hike into you. We will, that whole explanation I gave with you don't want to see these central banks getting super aggressive against inflation and just doing hikes to kick it down. Well, this is like on the threshold of the FOMC doing that and threatening, we'll kick you down if inflation comes back up. Yeah, so things so far for me, so good. We're seeing a bit of a rebound here. But I think that might be the top for the week. Again, I thought that we had tops for the week like 1 or 2 times before, and I've called it way too early this week a couple of times. But the whole point is you want to be able to be wrong, because you're going to be wrong a lot. doing this sort of stuff. So I'm just happy that I got this one right and that the Fed did this big old surprise that went in my favor. I'm just happy that happened. The chart's still covered. Yeah, I'm sorry about that. Good thing I wasn't super hard commentary. Yeah, I was just pointing out, yeah, you see this peak in the distribution for the month? That's why I'm saying, hey, this price around here, we might tap that and then have another pullback. Right? So something like that. Bum 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 bum. How many of you guys want to stick around for Powell's speech? Because this stream's been going on now for about an hour and 7, but I can keep going because I was gonna watch Powell's speech anyway. So you guys actually want me to watch it with you on the stream, maybe give my commentary and do more, because I don't know, man. I feel like I'm done trading for the day. Yeah, check that out. Right at the edge of the weekly distribution. Right at the edge. And look at that. 105.8 is at a peak right here. Yeah. So looking at this for the week, we'll probably head there by end of week. Especially if those flash PMIs do not surprise to the upside. Those flash PMIs have to surprise to the upside. They have to do good. Otherwise, this whole expectation, like, again, this is why I've erred on the side of staying long the dollar, even with all these things going on. It's like one bit of policy change like this, and it doesn't matter what's happening macro-wise in that economy. It just all goes poof on the FX side of things. So I leaned on the dollar side. We'll see going into next week, 2 weeks, 3 weeks from now. Powell, not paddle. Although he's kind of like being a paddle to markets right now. Yeah, check this out. This is the top 10 companies in the S&P 500. This is their own custom index that I made. And we're down on the day. I mean, we're down on the whole month for these guys, which ain't great. NASDAQ, down. Lord, if it keeps going down, you're talking 14,900 on the NASDAQ. Yeesh. That could be real bad if you continue to see some bearishness here on the tech side. Yeah. It'd be 15 on the futures contract. It'd be about 15 on the futures. Let's see here. Yeah, so hopefully that's the top. Hopefully I don't have to do any more micromanagement of these setups here. Yeah, and I pointed out where that could also be a top on the yen, but the yen is so freaking weak, and I'm not expecting any changes out of Japan, so it's just like, yeah, man. Euro still might hit my target for the month, right? Of 106. It might still hit 106 this month. That's still in the cards. Cool. I did send you the index, Isaac. I sent it to you in an earlier message. Lunch is over. All right, my man. I'm in. Oh, good for you, James. Nice to see you. You're in Eurodollar sells. Good on you, my man. Did anybody else take any trades today? I think Isaac did. Only couldn't get back. Oh, Isaac couldn't get back in his Eurodollar. But he got back in 3 out of 4 of them. All right, my man. Well, let's see if we can get that dollar move we were expecting. In all seriousness, I'm totally anticipating it now. I'm totally anticipating that the dollar will strengthen going into the end of this week. It'll probably hit these monthly targets on the DXY and Eurodollar. It'll probably reach those levels because they bumped up all of their forecasts for 2024, 2025, 2026. Well, 2026 is the new forecast, but also their longer run forecast. They bumped up everything across the board. Everything got hiked by effectively 50 points across all the time durations. And there was enough consensus, enough of the... See, each one of those dots represents an individual member of the Federal Reserve's Open Market Committee. And enough of those dots also moved up in consensus. So there's consensus at the Fed that the additional hiking is necessary. So as a whole, the Fed is just on aggregate getting more hawkish. So I'm definitely gonna err on the side of continued US dollar strength. And I am willing to take a guess that if there is a fiscal US government shutdown due to the US House not passing funding bills and there's a partial government shutdown, I'm willing to say maybe there's some dollar strengthening. Maybe there's some dollar strengthening going on during those periods in time. Maybe. I really want to get research on that. That's like the next thing I want to focus on. See, every Thursday, Friday, and Saturday, I get outlooks sent to me in my inbox. I get like 100, 200 emails a day. And I go through them all, and all of the free and open source and all the free stuff that I can find that's really, really good, I post it in the Outlooks channel in the Discord, all the research channels, all the geopolitics channels, all the trading channels. I post them all in there in the Discord for you guys to chat about, to discuss, to use, do whatever you want with them. But I use that stuff because I'm like trying to figure out trade plans, trying to figure out risks that could be happening around the bend here, around the corner. So then I'm just on top of stuff because I need to stay on top of stuff for this to make any sense to me. I gotta stay on top of what's actually happening. So then when I'm creating my future expectations to do my discretionary trading, that I have some basis in reality, right? Not just like, oh, wow, the Fed was hawkish today. Gee, I wonder why they'd be hawkish. Like, the reason why the Fed was more hawkish today was to bring this big old fat middle finger to OPEC. Right, to the Saudis and the Russians, because they're like, dude, we do not care how high and how much you pull back on your oil production. We will get the Iranians and the Venezuelans involved, and we will hike to keep our inflation down low. This hike is a middle finger to them, right? It's a big old middle finger. But also, it's not like our allies have really appreciated because the dollar gets more expensive for them. So, yeah, my man. Yeah. I think Ari asked, someone asked in the chat earlier, I have expectations that the dollar might be more hawkish. And I'm like, yeah, let me tell you why. Explicitly because of Russia and Saudi Arabia having economic and national policy saying that they are going to constrain supply to keep the price of oil high, that would increase inflation for a lot of people. And this is the US, the Federal Reserve, the FOMC, doing its thing to say, no, you will not. We will continue maintaining our strict monetary policy to step in front of that inflation and bring it down lower so you can do as minimal damage to the US economy as possible through oil price and energy prices. So while that wasn't, while that rant isn't totally unprecedented, and while that analysis and expectation isn't totally crazy or out there or novel, right? There's plenty of people who have that expectation. And I just riffed that off. The thing that actually made it interesting, this FOMC release, was when we looked at those dot plots, these things, they were way, way, way more hawkish than we anticipated across years, across 24 and 25, and now we have the 26 plots, but also across the longer run. Across the entire duration, it got bumped up significant, way more than expectations. And this is exactly how the FOMC would enact the big middle finger policy to the Russians and the Saudis trying to make oil more expensive. Here, let's read the Bloomberg article on Fed raises U.S. growth forecast, bolstering soft landing view. The Fed decision really revolves around nuances in the statement and guidance from September, particularly the dot plot. Market expectations were that the dots would move up in 2024 and 2025, with next year being a particular object of focus. The shift was hawkish as the 2024 dots moved to show just 50 basis points of rate cuts rather than the original 100 anticipated. That being said, risks are clearly tilted in that direction of being more hawkish. And it wouldn't be a huge shock to see the markets try to swing dovishly over the next hour or two. In all seriousness, that's still quite likely. It will probably try and take a stab risk on, but it's probably just going to be due to some temporary volatility measures. It's going to be robots mostly doing that. Let's see here. The changes to the FOMC statement is very minor as expected. Let's see here. Oh, Bespoke Investment Group. I follow and get emails from these people. Bespoke Investment. Like, this chart looks familiar. This little banner here, that's kind of their branding. They have this blue to green titles on all their charts. Market performance has been positive on Fed days, regardless of the rate decision too, with the S&P averaging a gain of 21 basis points. Let's see here. Note that the year-end 2024 implied rate in futures contracts is for federal funds rate. Again, the market is shrugging its shoulders at officials wiping off 50 basis points of cuts for 2024. And that seems reasonable. Seems somewhat reasonable, because now the question is Fed credibility. Does the Fed actually have the credibility to back up this more hawkish position? Will they actually hold it? Well, I have a feeling that they will hold it. I think the Fed is credible in their decisions here, and that they will hold this up pretty much explicitly, because if you do get, let's say you do get a more hawkish FOMC going forward from here that does realize itself, plus you do get, let's say, that outperformance out of the rest of the G7, and let's say some of these idiosyncratic US risks get materialized, but not all of them, everyone's going to kind of be on an even playing field. And then moving forward from that, it'd be quite easy for the Fed to maintain its more hawkish policy going forward until inflation did reach its targets within a timely fashion. And the same thing generally for the ECB as well. There are a lot of new members today, but the forecast for lower unemployment than previously expected is a standout. This Fed is saying that even as rates stay punishingly high, unemployment will now top out at 4.1% instead. Oh wow, they are really bullish on the US economy. That is very, very, very bullish. That is very pro-growth. I mean, that probably makes Bank of America feel very happy because they're bullish all throughout the end of this year. They just upped their forecast. Like they think that the S&P, I think, is going to end at 4,600, 4,700 by end of year. Let's see here. More from BI Jersey. We recently noted that the options market was partially priced for rates to be above the recent linear market pricing. Yeah. Yeah, we think Fed will be on hold. I found the new absence of any 2023 dots above 5.6%, which means even the most hawkish no longer see. Oh, that's actually a good insight right there. I find the absence of any 2023 dots above 5.6%, which means even the most hawkish in the FOMC no longer see 2 hikes by the end of this year. That is actually a fairly good observation. So see here, there's one person who thinks maybe there's going to be, what's that, 50 basis? Yeah, there's someone who thinks there's going to be 50 basis points of hikes in 2024. There's one person at the Fed. So that's interesting. But a lot of people are like, yeah, maybe we'll do one more hike. We'll be willing to do one more hike in November. That seems consistent. And so, yeah, that's actually a good bit of analysis here from Derek Tang. Let's see here. Comparing the 2024 dots with the previous projection. Oh, that just takes you to a Bloomberg terminal thing. Gotcha. Talk about hawkish. Real interest rates are heading higher next year. Gotcha. Let's see here. Powell is going to speak here in about 5 minutes. No, we have Powell speaking here relatively shortly. No. Yeah, Powell is going to be speaking here in a moment. Here, and I'll go ahead and bring up the charts on the right-hand side here. We'll go back to a 3 hour so we can check out things on the day. Ah, you missed those peaks. Sorry about that, Isaac. Oh, man. It's okay because tomorrow and Friday I'm taking my day trades with 10 and 20 basis points. Gotcha, my man. No, yeah. So I'll make money in that EU. That's good. It's all about taking it like one day at a time, one trade at a time. Never putting yourself at insane risk, right? Not doing the whole 1% risk per trade scam. Because, you know what, if you want to be able to take 10, 20, 30 trades and do day trades across all these different assets, you gotta be using smaller position sizes. Otherwise, the probability for risk of ruin is non-zero. Yeah. Will you guys still be back if I get a snack here real quick? Because I usually don't stream for this long. Like, most of the time, the streams are like 40 minutes, maybe an hour. We're now about an hour and a half into the stream. So, you know, seriously, thank you guys for watching. The view duration on the central bank streams are just insane. I see a lot of you guys watching still. And I'm glad to see the channel growing and all you guys watching, man. it's good to see. It's good to see the work paying off. It's good to see people enjoying the commentary. But yeah, I'm gonna get up and grab a snack here for like a minute or two. I'll be back before Powell starts to speak, but I'm gonna go up and do that right now. So I'll be right back.
Good afternoon, everyone. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, we are in a position to proceed carefully in determining the extent of additional policy firming that may be appropriate. Our decisions will be based on our ongoing assessments of the incoming data and the evolving outlook and risks. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. And so far this year, growth in real GDP has come in above expectations. Recent readings on consumer spending have been particularly robust. Activity in the housing sector has picked up somewhat, though it remains well below levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our Summary of Economic Projections, or SEP, committee participants revised up their assessments of real GDP growth, with the median for this year now at 2.1%. Participants expect growth to cool, with the median projection falling to 1.5% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 150,000 jobs per month, a strong pace that is nevertheless well below that seen earlier in the year. The unemployment rate ticked up in August, but remains low at 3.8%. The labor force participation rate has moved up since late last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises from 3.8% at the end of this year to 4.1% over the next 2 years. Inflation remains well above our longer run goal of 2%, 4% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 3.9%. Inflation has moderated somewhat since the middle of last year, and longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Nevertheless, the process of getting inflation sustainably down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.3% this year, falls to 2.5% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points. We see the current stance of monetary policy as restrictive, putting downward pressure on economic activity, hiring, and inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses. Range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings.
Seen quite a lot of volatility in markets here on the shorter time frames.
Monetary policy that is sufficiently restrictive to bring inflation down to our 2% goal over time. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 5.1% at the end of 2024, and 3.9% at the end of 2025. Compared with our June Summary of Economic Projections, the median projection is unrevised for the end of this year, but has moved up by 0.5 percentage point at the end of the next 2 years. These projections, of course, are not a committee's decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks.
All right, let's get into the questions, the
Given how far we
Q&A.
have come, we are in a position to proceed carefully as we assess the incoming data and the evolving outlook and risks. Real interest rates now are well above mainstream estimates of the neutral policy rate, but we are mindful of the inherent uncertainties in precisely gauging the stance of policy. We're prepared to raise rates
Dollar's
further
still down
as
on the day.
appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to
Come on. You got a buffer.
keeping longer-term inflation expectations well. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored.
That fixed it.
It's essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
All right, Q&A, the important part.
Thank you. Colby Smith with the Financial Times. What makes the committee inclined to think that the Fed funds rate at this level is not yet sufficiently restrictive, especially when officials are forecasting a slightly more benign inflation outlook for this year? There's noted uncertainty about policy lags. Headwinds have emerged from the looming government shutdown, the end of federal childcare funding, resumption of student debt payments, things of that nature.
So I guess I would characterize the situation a little bit differently. So we decided to maintain the target range for the federal funds rate where it is at 5.25% to 5.5%, while continuing to reduce our securities holdings. And we say we're committed to achieving and sustaining a stance of monetary policy that's sufficiently restrictive to bring down inflation to 2% over time. We said that. But the fact that we decided to maintain the policy rate at this meeting doesn't mean that we've decided that we have or have not at this time reached that stance of monetary policy that we're seeking. If you looked at the SEP, as you obviously will have done, you will see that a majority of participants believe that it is more likely than not that it will be appropriate for us to raise rates one more time in the 2 remaining meetings this year. Others believe that we have already reached that. So it's something where we're not making a decision by deciding to about that question, by deciding to just maintain the rate and await further data.
So right now, it's still an open question about sufficiently restrictive. You're not saying today that we've reached this level.
We're not saying, yeah, no. Clearly, what we decided to do is maintain the policy rate and await further data. We want to see convincing evidence, really, that we have reached the appropriate level, and you know, we're seeing progress, and we welcome that. But you know, we need to see more progress before we'll be willing to reach that conclusion.
And just on the 2024 projections, what's behind that shallower path for interest rate cuts and the need for real rates to be 50 basis points higher?
Right. So I would say it this way. First of all, real interest rates are positive now. They're meaningfully positive. And that's a good thing. We need policy to be restrictive so that we can get inflation down to target, okay? And we're going to need that to remain to be the case for some time. So I think, remember that of course, the SEP is not a plan that is negotiated or discussed really as a plan. It's accumulation, really, and what you see are the medians. It's accumulation of individual forecasts from 19 people, and then what you're seeing are the medians. So I wouldn't want to, bestow upon it the idea that it's really a plan. But what it reflects, though, is that economic activity has been stronger than we expected, stronger than I think everyone expected. And so what you're seeing is this is what people believe as of now will be appropriate to achieve what we're looking to achieve, which is progress toward our inflation goal, as you see in the SEP.
Thanks. Let's go to Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. How would you characterize the debate around another hike or holding steady? Is it discussion around lag times, fear of too much slowing, too little slowing? Could you walk us through what this disagreement was about at the meeting?
Yeah, so the proposal at the meeting was to maintain our current policy stance. And I think there was obviously unanimous support for that. But this, of course, is an SEP meeting, and so people write down what they think. And you have some, you saw, I think 7 wrote down no hike at this meeting, or between now and the end of the year, and I think 12 wrote down another single hike in one of the next 2 meetings that we have between the end of the year. So it wasn't like we were arguing over that. People just stating their positions.
Yep, pretty
And
good
really
consensus.
What people are saying is, let's see how the data come in. You know, we want to see, what we want to see. We want to see that these good inflation readings that we've been seeing for the last 3 months, we want to see that it's more than just 3 months, right? We want to see, the labor market report that we received, the last one that we received, was a good example of what we do want to see. It was a combination of across a broad range of indicators, continuing rebalancing of the labor market. So those are the 2 things. Those are our 2 mandate variables, and that's the progress that we want to see. But I think people, they want to be convinced, they want to be careful not to jump to a conclusion really one way or the other, but just be convinced that the data, support that conclusion. And that's why, given how far we've come and how quickly we've come, we're actually in a position to be able to proceed carefully as we assess the incoming data and the evolving outlooks and risks and make these decisions meeting by meeting.
And in your view, I know nothing has been decided yet, but what would one more hike at the end of the year do to the economy or to inflation? And on the other side, what would no hike do, if you could sort of game that out for us?
So, you can make the argument that one hike one way or the other won't matter, but for us, we're trying, obviously as a group, it's a pretty tight cluster of where we think that policy stance might be, but we're always going to be learning from data. We've learned all through the course of the last year that actually we needed to go further than we had thought. If you go back a year and what we wrote down, it's actually gotten higher and higher. So we don't really know and that's why, again, we're in a position to proceed carefully at this point. A year ago, we proceeded pretty quickly to get rates up. Now,
dollar's probably going to end above
fairly close,
105
we think,
today.
to where we need to get. It's just a question of reaching the right stance. I wouldn't attribute huge importance to one hike in macroeconomic terms. Nonetheless, we need to get to a place where we're confident that we have a stance that will bring inflation down to 2% over time. That's what we need to get to, and we've been moving toward it. As we've gotten closer to it, we've slowed the pace at which we've moved. I think that was appropriate. And now that we're getting closer, we have the ability to proceed carefully.
Let's go to Steve.
Steve Leisman, CNBC. Mr. Chairman, I want to return to Colby's question here. What is it saying about the committee's view of the inflation dynamic in the economy that you achieve the same forecast inflation rate for next year, but need another 0.5 point of the funds rate on it? Does it tell us that the committee believes inflation to be more persistent, requires more medicine effectively? And I guess a related question is, if you're going to project a funds rate above the longer run rate for 4 years in a row, at what point do we start to think, hey, maybe the longer rate or the neutral rate is actually higher? Thank you.
So I guess I would point more to, rather than pointing to a sense of inflation having become more persistent, I wouldn't think that's not, we've seen inflation be more persistent over the course of the past year, but I wouldn't say that's something that's appeared in the recent data. It's more about stronger economic activity, I would say. So if I had to attribute one thing, again, we're picking medians here and trying to attribute one explanation, but I think broadly, stronger economic activity means rates, we have to do more with rates,
And that's what that meaning is telling you. In terms of what the neutral rate can be, we know it by its works. We only know it by its works, really. We can't the models and the economy reacts. And again, that's another reason why we're moving carefully now, because there are lags here. So it may of course be that the neutral rate has risen. You do see people. You don't see the median moving, but you do see people raising their estimates of the neutral rate. And it's certainly plausible that the neutral rate is higher than the longer run rate. Remember, what we write down in the SEP is the longer run rate. It is certainly possible that that the neutral rate at this moment is higher than that, and that's part of the explanation for why the economy has been more resilient than expected.
Let's go to Howard.
Howard Schneider with Reuters. Thank you. So you've said several
Reuters.
times that the economy needed a period of below-trend growth to get inflation consistently back to 2%. You kind of get that in 2024, a little bit. 1.5% is just a touch below what's the estimate of potential. So the fact that you're getting so much done at so much less cost, does that represent a change in how you think inflation works, a change in how you think the economy works, a change in the mix of supply healing versus demand destruction that's necessary to achieve this?
Yes, of course, it is a good thing that we've seen now meaningful rebalancing in the labor market without an increase in unemployment.
Very
And
smart
that's
question.
Because we're seeing that rebalancing in other places, in, for example, job openings, and in the jobs worker gap. You're also seeing supply side things. So that's happening. I would say, though, I still think, and I think broadly people still think that there'll have to be some softening in the labor market. That can come through more supply, as we've seen as well. Also, remember, the natural rate we think is coming down, which is a supply side thing, so that the gap between any given unemployment rate that's lower than that and the natural rate comes down. That's a way for supplies. That's a way for the labor market to achieve
So
that balance.
his answer to that
all
is
of those things are
supply
happening.
chain.
You're right. In the median forecast, we don't see a big increase in unemployment. We do see an increase. And but that really is just playing forward the trends that we've been seeing. That is not guaranteed. There may come a time when unemployment goes up more than that, but that's really what we've been seeing, is progress without higher unemployment for now.
So just to boil that down for a second, we've gone from a very narrow path to a soft landing to something different. Would you call the soft landing now a baseline expectation?
No, I would not do that. I would just say, what would I say about that? I've always thought that the soft landing was a plausible outcome, that there was a path, really, to a soft landing. I've thought that, and I've said that since we lifted off. It's also possible that the path is narrowed and it's widened, apparently. Ultimately, this may be decided by factors that are outside our control at the end of the day. But I do think it's possible, and I also think this is why we're in a position to move carefully again. That we will restore price stability. We know that we have to do that, and we know the public depends on us doing that. And we know that we have to do it so that we can achieve the kind of labor market that we all want to achieve, which is an extended period, sustained period of strong labor market conditions that benefit all. We know that. The fact that we've come this far lets us really proceed carefully, as I keep saying. So I think that's the end we're trying to achieve. I wouldn't want to handicap the likelihood of it, though. It's not up to me to do that.
Nick Timmeros of the Wall Street Journal. Chair Powell, both you and Vice Chair Williams have indicated that sufficiently restrictive will be judged on a real rather than nominal basis, implying some scope for nominal rate cuts next year, provided further compelling evidence that price pressures will continue to subside. Is the FOMC focused on targeting a real level of policy restriction? And can you explain what would constitute enough evidence that will allow the FOMC to normalize the nominal stance of policy while keeping real policy settings sufficiently restrictive?
I mean, yes, we understand that it's a real rate that will matter and that it needs to be sufficiently restrictive. Again, I would say you know sufficiently restrictive only when you see it. It's not something you can arrive at with confidence in a model or
That's not super encouraging,
so what
Powell.
are we seeing? We're seeing, through a combination of the unwinding of the pandemic-related demand and supply distortions and monetary policy's work in suppressing demand or alleviating very high demand. The combination of those two things is actually working. You're seeing, inflation coming down. It's principally now in goods, also in housing services. You begin to see effects of it in non-housing services as well. So we think that is working. And I think, as we've said, we want to reach that, we want to reach something that we're confident it gets us to that level. And I think confidence comes from seeing, enough data that you feel like, yes, okay, this feels like we can, for now, decide that this is the right level and just agree to stay here. We're not permanently deciding not to go higher, but we would, let's say if we get to that level. And then the question is, how long do you stay at that level? And that's a whole nother set of questions. For now, the question is trying to find that level where we think we can stay there. And we haven't gotten to a point of confidence about that yet. That's the stage
this year. And even then, it seems possible that core PCE inflation could come in even lower than the median at 3.7%. Would you see a case to raise rates still if it turned out that you were going to achieve the same real rate this year because the decline in inflation proceeds somewhat better than you currently anticipate?
The decision that we make at each meeting, and certainly at the last two meetings this year, it's going to depend on the totality of all the data. So the inflation data, the labor market data, the growth data, the balance of risks and the other events that are happening out there. We take all of that into account. So I can't really answer a hypothetical about one piece of that. It'll be
that is a
trying to
smart
reach
answer.
Judgment over whether we should move forward with another rate hike overall, and whether that would increase our confidence that yes, this is an appropriate move, and it will help us be more confident that we've gotten to the level that we need to get to.
We'll be in restrictive territory when we see it. That's not instilling a whole lot of confidence.
Powell, following up on Nick's question, actually, John Williams, the New York Fed president, obviously, has said things to the effect of next year, as we see inflation, kind of again to Nick's point, as we see inflation coming down, we're going to need to reduce interest rates to make sure that we're not squeezing the economy harder and harder over time. And I wonder if that's basically the logic that you apply. Is that how you think about it? And then I also wonder, in the last press conference, you said something to the effect of, it's a full year out, those discussions, and people interpreted that to mean that you didn't see a possibility of a rate cut in the first half of next year. And I wonder if that was what you meant by that, or whether, how you're thinking about that timing.
No, when I answer these questions about hypotheticals about cutting, I'm never intending to send a signal about timing. I'm just answering them as the question is expressed. So please, I wouldn't want to be taken that way. Sorry, the first question was that how? Yeah, so we're, as we go into next year, that's the question we'll be asking is, taking into account lags and everything else we know about the economy and everything we know about monetary policy. The time will come at some point, and I'm not saying when, that it's appropriate to cut. Part of that may be that real rates are rising because inflation is coming down. Part of it just may be that it'll be all the factors that we see in the economy. And that time will certainly come at some point. And what you see is us writing down, a year ahead estimates of what that might be. And there's so much uncertainty around that. When we, in the moment, we'll do what we think makes sense. No one will look back at this and say, hey, we made a plan. It's not like that at all. These are estimates made a year in advance that are highly uncertain, and that's how it is.
Neil.
Thanks so much, Chair Powell. Neil Irwin with Axios. Wonder, how do you think about the question of whether the strong GDP growth that we've been seeing is driven by excess demand versus supply side factors, productivity, labor force growth? And relatedly, if GDP keeps coming in hot, even in the absence of an inflation resurgence, would that on its own be a reason to consider more tightening?
No.
So on your first question, I mean,
What?
we're looking at GDP very, very carefully to try to understand really what's the direction of it, what's driving it, and it's a lot of consumer spending. The consumer's been very robust in spending. So that is, that's how we're looking at it.
Axios
Sorry, your second
never
question was-
usually asks the smart
stayed
questions
hot
at these
without
meetings.
inflation.
So I think the question will be, GDP is not a mandate, right? Maximum employment and price stability are the mandates. The question will be, is GDP, is the heat that we see in GDP, is it really a threat to our ability to get back to 2% inflation? That's going to be the question. It's not a question about GDP on its own. It's you're expecting to see this improvement, continued rebalancing in the labor market and inflation moving back down to 2% in a sustainable way. We have to have confidence in that, and we'd be looking at GDP just to the extent that it threatens one or both of those.
Hi,
Which it's
Victoria
not.
Ueda with Politico. There are multiple external factors that are playing out right now. We see rising oil prices. We see auto workers striking. There's the looming, very real possibility of a government shutdown. And I was just wondering, for each of those things, could you talk about how you're thinking about how that might affect the course for the Fed and the economy?
So there is a long
Ah,
list, and you
finally,
hit
a
some of them.
UAW question.
It's the strike, it's government shutdown, resumption of student loan payments.
Wow,
higher
they're aware.
long-term rates, oil price shock. There are a
course.
lot of things that you can look at. So what we try to do is assess all of them and handicap all of them. And ultimately, though, there's so much uncertainty around these things. I mean, to start with the strike, first of all, we absolutely don't comment on the strike, as we have no view on the strike one way or the other, but we do have to make an assessment of its economic effects to do our jobs. So, the thing about it is so uncertain. It will depend. The economic effects, it could affect, we've looked back at history, it could affect economic output, hiring, and inflation, but that's really going to depend on how broad it is and how long it's sustained for. And then it also depends on how quickly production can make up for lost production. So none of those things are known right now. It's very, very hard to know. So you just have to leave that uncertain and
You know what? He hit the nail right on the head.
over the course of the next intermeeting period. It hasn't traditionally had much of a macroeconomic effect. Energy prices being higher, that is a significant thing. Energy prices being up can affect spending. It can affect over time. A sustained period of higher energy prices can affect consumer expectations about inflation. We tend to look through short-term volatility and look at core inflation. But so the question is, how long are higher prices sustained? We have to take those macroeconomic.
This is the most important question the entire meeting.
Those are some of them. I'm not sure if I hit them all, but ultimately, you're coming into this with an economy that appears to have significant momentum, and that's what we start with. But we do have this collection of risks that you mentioned.
God, I wish you'd expand on that. Talk for another minute or two about that, please.
I was a little surprised, Chair Powell, to hear you say that a soft landing is not a primary objective. This economy is seeing added supply in a way that could create long-term inflation stability. We have prime age labor force participation moving up where people can add skills. Workers want to work. We have a boom in manufacturing construction. We've had a decent spate of home building. And since inflation's coming down with strong GDP growth, we may have higher productivity. All are which good for the Fed's longer run target of low inflation. And if we lose that in a recession, aren't we opting for the awful hysteresis that we had in 2010? So are you taking this into account as you pursue policy? Thank you.
To begin, a soft landing is a primary objective, and I did not say otherwise. I mean, that's what we've been trying to achieve for all this time. The real point, though, is the worst thing we can do is to fail to restore price stability, because the record is clear on that. If you don't restore price stability, inflation comes back, and you go through, you can have a long period where the economy is just very uncertain, and it'll affect growth, it'll affect all kinds of things. It can be a miserable period to have inflation constantly coming back and the Fed coming in and having to tighten again and again. So the best thing we can do for everyone, we believe, is to restore price stability. I think now, today, we actually, we have the ability to be careful at this point and move carefully, and that's what we're planning to do. So we fully appreciate the benefits of being able to continue what we see already, which is rebalancing in the labor market and inflation coming down without seeing, an important, large increase in unemployment, which has been typical of other tightening cycles. So.
Hi, thank you. Chris Rugaber at Associated Press. When you look at the disinflation that has taken place so far, do you see it mostly as a result of what some economists are calling the low-hanging fruit, such as the unwinding of supply chain snarls and other pandemic disruptions, or is it more a broad disinflationary trend that involves most goods and services across the economy? Thank you.
So if I understood your question, I would say it this way. I think we knew from before when we lifted off, but certainly by the time we knew that bringing inflation back down was going to take, as I call it, the unwinding of these distortions to both supply and demand that happened because of the pandemic and the response. So that unwinding was going to be important. In addition, monetary policy was going to help. It was going to help supply side heal by cooling demand off, and just in general, a lot better aligning supply with demand. So those two forces were always going to be important. I think it's very hard to pull them apart. They work together. I do think both of them are at work now, and I think they're at work in a way that shows you the progress that we are seeing.
Michael McKee from Bloomberg Television and Radio. In June, you forecast a 5.
Oh. Another round of buffering, please. Right when Bloomberg starts to ask their questions. Oh, man. FYI, I'm going to be in the Discord.
Justify that last move, because the median forecast is for lower inflation. And given all the known unknowns that you face, how much confidence do you have, can investors have, or the American people have in your forecasts?
Well, forecasts are highly uncertain. Forecasting is very difficult. Forecasters are a humble lot with much to be humble about. But to get to your question, though.
Very good question.
What's happened is growth has come in stronger, right? Stronger than expected. And that's required higher rates. Unemployment, you also see that the ultimate unemployment rate is not as high, but that's really because of what we've been seeing in the labor market. We've seen more and more progress in the labor market without seeing significantly higher unemployment. So we're continuing that trend. In terms of inflation, you are seeing the last 3 readings are very, very good readings. It's only 3 readings. We were well aware that we need to see more than 3 readings. But if you look at June, July, and August, you're looking at really significant declines in core inflation, largely in the goods sector, also to some extent in housing services, and just a little in non-housing services. Those are the 3 buckets. Headline inflation, of course, has come way down, largely due to lower energy prices, some of which is now reversing. So I think people should know that economic forecasting is very difficult, and these are highly uncertain forecasts. But these are our forecasts. We have very high quality people working on these forecasts, and I think they stand up well against other
trust
forecasters.
us is what Powell said. Just trust us. Just trust us, man.
It's very difficult to forecast.
Given the forecast that you have, what justified not moving today, and what could justify moving in the future if you think?
Well, I think we have come very far, very fast in the rate increases that we've made, and I think
moving today, and what could justify moving in the future if you think?
Well, I think we have come very far, very fast in the rate increases that we've made, and I think it was important at the beginning that we moved quickly, and we did, and I think as we get closer to the rate that we think, the stance of monetary policy that we think is appropriate to bring inflation down to 2% over time, the risks become more two-sided, and the risk of over-tightening and the risk of under-tightening becomes more equal. And I think the natural common sense thing to do is, as you approach that, you move a little more slowly as you get closer to it, and that's what we're doing. So we're taking advantage of the fact that we have moved quickly to move a little more carefully now as we sort of find our way to the right level of restriction that we need to get inflation back down to 2%.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. With your focus on year-over-year PCE, isn't it true that base effects are huge, and that by the time you meet in November, that it's more likely that you'll have a low PCE number that would make you feel more comfortable? And secondly,
It's
how
all
will
the
lack of
young,
key indicators
beautiful
like
women who are
CPI,
asking
jobs
all the
report
smartest
impact your
questions.
approach in upcoming meetings if we were to have a government shutdown? Thank you.
Yeah, I missed the first question. What was the what factors?
The base factors.
Base factors.
When we say we need women in finance, this is what we need.
So on that, we're looking at just monthly, right? You can look at just monthly readings and see what the increase was from the prior month. So you're right. When you go back 3, 6, and 12 months, you get base factors, but we can adjust for that. In terms of not getting data, again, we don't comment on government shutdowns. It's possible if there is a government shutdown and it lasts through the next meeting, then it's possible we wouldn't be getting some of the data that we would ordinarily get, and we would just have to deal with that. And I don't know. It's hard for me to say in advance how that would affect that meeting. It would depend on all kinds of factors that I don't know about now, but it's certainly a reality that's a possibility.
Would you feel more comfortable on the base effects as those kind of fall out of the equation for the next couple of readings by November? Would you feel more comfortable at that point?
Yes. I mean, if you're looking, if we can tell how much inflation has gone up in a given month, right? And that's what we're looking at. And month by month, what's the reading? And I think what we're really looking at is there's a tendency to look at shorter and shorter maturities, but they're incredibly volatile and they can be misleading. That's why we look at 12-month. But I think in this situation where it looks like we've had a bit of a turn in inflation starting in June, we're also looking at 6 months and even 3 months, but really 6 months inflation. So you're looking at it over that period and over longer periods. That's
We're looking at 12 months, but really 6 months, but maybe 3 months.
In getting to a conclusion about what to do, we can let the data evolve.
Thanks for the question, Chair Powell. Edward Lawrence with Fox Business. So I want to focus back in on oil prices. We're seeing oil prices, as you mentioned, move
thank
up,
God.
and that's pushing the price of gas. So how does that factor into your decision to raise rates or not? Because the last two inflation reports, PCE and CPI, we've seen the overall inflation has actually risen.
Right. So,
yeah, the core rose.
Energy prices are very important for the consumer. This can affect consumer spending. It certainly can affect consumer sentiment. I mean, gas prices are one of the big things that affects consumer sentiment. It really comes down to how persistent, how sustained these energy prices are. The reason why we look at core inflation, which excludes food and energy, is that energy goes up and down like that, and it doesn't. Energy prices mostly don't contain much of a signal about how tight the economy is, and hence don't tell you much about where inflation's really going. However, we're well aware, though, that if energy prices increase and stay high, that'll have an effect on spending, and it may have an effect on consumer expectations of inflation, things like that. That's just things we have to monitor. So.
On the consumer, they're putting more and more of this on their credit card. The consumer seeing a record credit spending. How long do you think the consumer can manage that debt at higher interest rates now? And are you concerned about a debt bubble related to that?
So to finish my prior thought, I was saying that's why we tend to look through energy moves that we can see as short-term volatility. Turning to consumer credit, of course we watch that carefully. Consumer distress, measures of distress among consumers were at historic lows quite recently, during and after the pandemic. They're now moving back up to normal. We're watching that carefully, but at this point, these readings they're not at troublingly high levels. They're just kind of moving back up to what was the typical in the pre-pandemic era.
Hi, Jean Young with M&I Market News. Yields
Oh,
along the Treasury
M&I.
curve have risen to their highest in years. What is the Fed's view about what's been driving that increase in recent weeks? And how much of it can be attributed to macro explanations and how much to technical factors?
Ooh, M&I. M&I is one of the
You're
biggest
right.
Fed insider
Rates have
reporters.
moved up significantly. I think it's always hard to say precisely, but it's most people do a common decomposition of the increase, and the view will be it's not mostly about inflation expectations. It's mostly about other things, either term premium or real yields, and it's hard to be precise about this. Of course, everyone's got models that'll give you a very precise answer, but they give you different answers. So, but essentially, they're moving up because it's not because of inflation. It's because probably
Dollar
they'll
will probably end
have
up bullish
something
for
to
the
do with
rest of the
stronger
month
growth.
unless those PMIs come in with a positive
supply
growth
treasuries.
surprise.
But, the common explanations that you hear in the markets kind of make sense.
So next big risk event's going to be those flash PMIs coming out this Friday.
Kyle Campbell, American Banker. Thank you for taking the questions. Just two on housing.
Dollar still chugging
Slower
here.
Shelter cost growth is in the pipeline and will reflect in inflation readings as new leases are signed. But there's also some questions out there about the way housing costs are measured, particularly the use of rental equivalents, which are
Pretty young
estimates
guy.
from homeowners about what their homes would rent for if they were in the rental market. So my question is, how much of the effort to tame inflation, both as it's measured and felt by the broader public, hinges on housing supply?
It makes sense that the younger guy would be concerned about housing inflation because obviously he wants to get a damn
Sort of
house.
exacerbated by this sort of lock-in effect of mortgages being higher now than they were.
And yeah, I'll be in the
recent historic
Discord.
lows.
I mean, I'm in the Discord technically right now. So anyone who wants to hang out after the stream, go ahead, hop
So
on
the
in.
supply point, of course, supply is very important over time in setting house prices and for that matter rents, and supply is kind of structurally constrained. But in terms of where inflation's going in the near term, though, as you obviously know, a lot of it is leases that are running off and then being re-signed or released at a level that's it won't be that much higher. A year ago it would have been much higher than it was a year before. Now it may be below or at the same level. So as those leases are rolling over, we're seeing what we expect, which is measured housing services inflation coming down. Your second question was the lock-ins. How much is that affecting things, really?
Is that going to affect your decisions to potentially bring rates down to their lower bound in the future, sort of creating that sort of bubble of buying and then a lock-in that sort of stagnates the housing market?
I think we look at I would look at the lock-in, the idea being that people are in very low rate mortgages, and even if they want to move now, it would be hard because the new mortgage would be so expensive. Play a role in our future decisions in a future loosening cycle about whether we would cut rates? No, I don't think it would. I mean, I don't think that's. I think we'd be looking at fundamentally what rates does the economy need, and in an emergency like the pandemic or during the global financial crisis.
Yeah, it was kind of a dumb question this guy asked.
You have to cut rates to the point.
But
do what you can.
At least getting his opinion on housing, getting Powell's opinion on housing was
that would be
nice.
for us not to do that. It's not something we're thinking about at all right now, but down the road, I wouldn't think so.
Hi, Nancy Marshall-Genser with Marketplace. Chair Powell, you've mentioned several things.
Oh, that's
that
Ueda
would
stuff.
possibly
Marketplace
weigh
is
on
Ueda
consumer
stuff,
confidence,
right?
maybe cut back consumer spending, possible government shutdown, high gas prices. At this point, would the Fed welcome a decrease in consumer spending? Would that help you get inflation closer to your 2% target?
I wouldn't say it that way. We're not looking for a decrease in consumer spending. It's a good thing that the economy is strong. It's a good thing that the economy has been able to hold up under the tightening that we've done. It's a good thing that the labor market's strong. The only concern, and it just means this: if the economy comes in stronger than expected, That just means we'll have to do more in terms of monetary policy to get back to 2%, because we will get back to 2%. Does that answer your question?
Yeah, and I guess on the other hand, would you worry that that could contribute to an economic slowdown or even a recession?
Well, that's always a concern. I mean, concern number one is restoring price stability, because in the long run, that's something we have to do so that we can have the kind of economy we really want, which is one with sustained period of tight labor market conditions that benefit all
Yeah,
of us,
it's
a couple times.
pretty
so
straightforward answer there.
That said, of course, you know, we also now, given how far we've come with our rate hikes and how quickly we've come here, we do have the ability to be careful as we move forward because of that consideration.
Yeah, and marketplace isn't Ueda's thing. It's
thank you, Chair Powell. Simon Rabinovich with The Economist. One of the factors in the economic resilience to date appears to be a lesser degree of rate sensitivity than in the past. Obviously, we've talked about households with long fixed rate mortgages, also companies that refinanced before last year. What is your thinking about the efficacy of rates and how that's changed? And then related to that, how do you think about the distributional consequences in the sense that if you're a relatively wealthy household with a long fixed rate mortgage, the past year has not been all that tough with rates going up, whereas if you're relying on your credit card for supporting your consumption, in fact, times are getting a lot tougher, a lot more quickly. Thanks.
So what? I guess it's fair to say that the economy's been stronger than many expected, given what's been happening with interest rates. Why is that? Many candidate explanations. Possibly a number of them make sense. One is just that household balance sheets and business balance sheets have been stronger than we had understood, and so that spending is held up and that kind of thing. We're not sure about that. The savings rate for consumers has come down a lot. The question is whether that's sustainable. That could be. It could just mean that the date of effect is later. It could also be that for other reasons, the neutral rate of interest is higher for various reasons. We don't know that. It could also just be that policy hasn't been restrictive enough for long enough. And there are many candidate explanations. We have to, in all this uncertainty, make policy. And I feel like what we have right now is what's still a very strong labor market, but that's coming back into balance. We were making progress on inflation. Growth by many forecasts, many forecasts call for growth to moderate over the course of the next year. So that's where we are, and we have to deal with what comes. On your second question your second question was distributional, but can you be a little clearer about that?
Yeah, my point there was that if you're somebody who has a long fixed rate mortgage, you've been able to endure the higher rates relatively easily. If you're somebody who's living month to month off of your credit card, current financing rates are punitive.
Yes, and so the point I would make there is that we're trying to get inflation back down. The people who are most hurt by inflation are the people who are on a fixed income. If you're a person who spends all of your income, you don't really have any meaningful savings. You spend all your income on the basics of life: clothing, food, transportation, heating, the basics. And prices go up by 5, 6, 7%. You're in trouble right away. Whereas even middle class people have some savings and some ability to absorb that. So it is for those people, as much as for anybody, that we need to restore price stability. And we want to do it as quickly as possible. Obviously, we would like to do that. We'd like the current trend to continue, which is that we're making progress without seeing the kind of increase in unemployment that we've seen in past things. But you're right, though. When we raise rates, people who are living on credit cards and borrowing are going to feel that more. They are. And of course, people with lots of savings also have a much lower marginal propensity to consume, and so it's not going to affect them as much.
I'm going to do a little happy dance.
Thank you, Chair Powell. Greg Robb from MarketWatch. In the Beige Book recently, you can tell that the Fed has been surveying nonprofits and community groups about the economic health of low-income Americans, moderate growth Americans. I have two questions about this.
Oh, this is good.
Are you going to use that data to maybe come up with a sort of like a quarterly survey of those groups, like the senior loan officer survey? And
that's smart.
And also the second question is, from your recent readings of these surveys, how are low and moderate Americans doing? Is there this thing where like the GDP is strong because of wealthy Americans kind of driving things? I just want to get your sense of the health of
God, that's an awesome question.
So I don't know about the quarterly survey. That's an idea we can take away and think about. In terms of how low and moderate Americans,
do that, Powell. Do that.
They're clearly we're suffering from high inflation. I think during the pandemic, the government transfers that happened were very meaningful. And if you know the surveys that we take showed that low and moderate income people were actually in very, very strong financial condition. I think now it's a very hot labor market, and you're seeing high nominal wages, and you're starting to see real wages are now positive by most measures. So I think overall households are in good shape. Surveys are a different thing. So surveys are showing dissatisfaction. And I think a lot of that is just people hate inflation, hate it. And that causes people to say the economy is terrible, but at the same time they're spending money.
Terrible.
Behavior is not exactly what you would expect from the surveys. That's kind of a guess at what the answer might be. But I think there's a lot of good things happening on household balance sheets, and certainly in the labor market and with wages. The biggest wage increases having gone to relatively low wage jobs. And now inflation coming down, you're seeing real wages, which is a good thing. Thanks very much.
Is that it? I'd say all in all, those were some pretty okay questions. All in all, that was actually fairly productive. There was maybe only 3 or 4 questions that were actually especially good. But I think that's ultimately because most of the expectations that people really had for the our Q4 expectations mostly has already been answered. Like, as soon as people saw that dot plot, it's like, okay, maybe we get, literally there were only like 2 questions pertinent to changes in FOMC participants' views and stances on those dot plots. And that was the actual useful information out of the Q&A. But outside of that, it's like, okay, that's that. Man, it's been quite a stream. If anyone wants to hang out with me in the Discord, go ahead and hop into one of the voice chats, and I'll come in and say hello. I'm doing my little happy dance also because I've pretty much made back all of my paper cuts so far. So I am now in very, 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 very good standing with myself and the kind of performance I anticipate that I can extract from the market. So I'm very happy with what I got, what I'm getting, and what I'm expecting going forward from here. I think the rest of this week and part of next week are going to be relatively straightforward. And man, thank you guys. Some of you guys have been watching for a long, long time. The average, I can see you guys who hang around here. Just thank you guys very, very much. Moneybags in the chat all around. Moneybags for everyone in the chat. And for all you guys who've stuck around this far, who've been helping this channel grow, helping me get a viewership, reach out to more people, show them how to do research, right? Showing them, oh, you know, it'd be nice if you had some probabilities for your trade. Oh, it'd be nice if we had some commentary from someone who is actually reading research on these events. And then also, I'm still pretty easy to get access to here because my channel isn't super huge. I'm not getting like hundreds of people watching me. So if you've found me and you're watching this while I'm still not, you know, super huge, take advantage of the trading group. That's $100 a month. Take advantage of my time because I, you know, give like quite personalized chats with people still, while there isn't a whole lot of demand for it. But it's nice to see that the channel's growing, that there is demand for my commentary, that the people who are interested in what I gotta say are watching and are listening and are interacting. I gotta thank you, Ari, for all the chats, and you, Isaac, for all the chats, and everybody else for all your chats. Yeah, man, it feels good. It feels good seeing good stuff coming out of the channel and coming out of the trade group, and actually watching people learn more about the world and actually get better at their discretionary decisions. So with that all said, I'm going to go ahead and end the stream and move this on over to Discord, where over, I think, the rest of today, tomorrow, pretty much the next 72 hours is going to be a research bonanza in the Discord, because Lord, there's going to be, everyone's going to be coming out of the woodwork now that FOMC is over, riding all of their week ahead expectations, and month ahead expectations will start coming down the pike next week for the month of October. So we're going to be getting a hell of a lot of good research, and we're going to be getting some excellent breakdowns, and now it's just going to be a matter of just managing stuff into the end of the month, maybe seeing some dollar strength relatively go up just a bit, and then just managing that little bit of dollar strength going into the end of September. Again, the one thing I'll say here before I sign off is watch out for those flash PMIs. I'm certain that once Thursday comes around, I'll probably have a report on S&P Global. They usually do release a report, an anticipative report saying, hey, you know, these are the general expectations, and this would be a good number, this would be a bad number, here's why we have these expectations around these numbers. And we'll see what kind of insights we can get out of the outlooks going into the week ahead that I'll be sharing over in the Discord. So come hop on in. If you got any questions about any of the research, come chat me up and hop into the trade group. I'll show you how to use my indicators. It doesn't take long to learn how to use them. And enjoy the research. All the research stuff is free. You don't need to be in a trading group for that stuff. Whoa. Let's go ahead and sign off, you guys. Thank you guys for watching the stream. I've been your boss, Joe Boss. And I'll see you guys in a bit.